Part 2, Basic Concepts in the Accounting Industry. Chapter 7, VAT and the VAT Control Account. So the key points in this chapter are: VAT is paid to HMRC on sales, and that's known as output VAT. VAT can be recovered from HMRC on purchases, input VAT. HMRC is Her Majesty's Revenue and Customs. VAT is payable and recoverable at different rates which were provided within the question, and they're actually in real life dependent upon the type of organisation and the type of goods and services supplied. VAT will always be paid by the selling company on sales, so the seller pays VAT, not the purchaser, although it's added onto the purchaser's price, and it'll be recovered by the buying company on purchases. So before moving on to accounting for sales and purchases, it's important to gain a strong understanding of value-added tax, VAT, which is a tax on sales that may be payable based upon the extent of the company's sales, the type of company that it is, and the supply of goods and services being made. Organisations may be not registered for VAT because they're too small. They might be zero rated, so the organisation might be zero rated regardless of the goods or services provided, so that no VAT is chargeable, and those are local authorities and the NHS, types of government organisations. Note that that's the government and the organisation, not the goods and services they provide. For these organisations, even though VAT may be applicable on their goods and services, they're still set to zero, or the organisation most typically may be subject to VAT. Rates of VAT that may be chargeable are dependent upon the types of goods and services sold. So the charge is the same in VAT, because the charge is the same for absolutely everybody in society. It becomes a sort of disproportionate effect on the poorest in society. So 20% on somebody who owns, makes £100,000 a year versus 20% for somebody who's on benefits. The person who's on benefits is paying a proportionally higher amount of VAT on, let's say, energy. And as a result, certain goods have different VAT rates. Those VAT rates can be zero rated, so no output VAT is chargeable, but the input VAT can be reclaimed. Exempt, so no output VAT is chargeable, but the input VAT rate cannot be reclaimed. Low rate, so a lower rate because of the types of goods and services and the disproportionate effect that it has on the poorest in society. So those would be energy costs typically. Or standard rated, which is currently 20%. Now, in an exam, you won't be required to, in this exam for bookkeeping transactions, you won't be able to require to know these different organisations or different rates and why, and that's at later units in there. But it's useful to have an idea that what is driving this VAT rate. So you'll be given the VAT rate and then you're going to calculate it. Whereas supplying goods and services subject to VAT, the company sells a product for an amount. So they sell a product for an amount, and that's called the net amount. And then an additional taxation, VAT, is added, which is payable to the government through Her Majesty's Revenue and Customs, HMRC. The seller collects this money from the buyer and pays it to HMRC. The buyer does not pay that amount direct to HMRC. So if the seller sells something, let's say for £100, and £20 worth of VAT is added, the buyer will pay the seller £120. The seller will pay HMRC the 20. It won't be the buyer paying the seller 100 and then paying HMRC the additional 20. However, imagine a world where only sales tax is applied to every chain of the link of sales. So Company A, and each company in this one's here are sort of adding on £25 worth of cost, or price to the amount that they need to do. So Company A sells some raw materials to Company B to make a component. It adds on 20% for this 25, so it sells it for 30. Company B then sells the component to Company C. It adds on £25 worth for its costs and profit that it wants to make, and it has to add on this VAT here, which is an selling price of 66. Company C adds on another £25 worth of amounts there, though, adds on its VAT as well. It sells it to Company D. Company D goes along, adds its costs on top of it as well, adds VAT in it, and sells it to the final company here. So from Company A to D, there's 4 lots of VAT being added, and a total in this one VAT payable of £61.04. So compare that to a situation where Company E just does all of the work itself, and then it goes and sells that product to the final customer. All it will do, it will have its £100 worth of costs, which is the same cost as Company A, B, C and D incurred, and the amount that they wanted to charge, and then it will only charge one lot of VAT of £20. In a world where companies could not recover VAT, there'd then be a huge financial advantage for one company to create the whole product, that's known as vertical integration, rather than several companies. However, this decision will be wholly driven by taxation and not the efficiency, economy, and the organisational decision making. Taken to extremes, a pizza parlour, for example, would attempt to run a pineapple plantation to avoid paying VAT on the topping for a ham and pineapple pizza. Such a VAT approach would quickly make for a nonsense economy. In order to make VAT and sales taxes workable, companies who charge VAT on sales tax, output tax, can then recover the VAT on the purchases they make, so this is known as input tax. So companies A to D transactions would actually really, in the real world, be company A charges 25%, adds on output VAT, and then charges £30 in total. Company B might pay £30, but then it recovers this £5 of VAT. It then adds on its £25 worth of costs, and it charges its VAT of £10. Company C then goes along and it will now charge, it will now recover its VAT of £10, add on its 25, charge 50, until it's then have an output price of 90. Company D recovers its input VAT, adds on its costs, charges it the VAT, and then that's its selling price to the final seller. So in this situation, and here, whilst £50 worth of VAT is charged, £30 of VAT is recovered, and as a result, there's no taxation advantage from vertical integration. The net amount of VAT payable to HMRC is £20. Where a company charges output VAT on sales, VAT on purchases is typically recovered. The output on VAT on sales, therefore, from let's say we take company C in this situation here, we will typically go debit, bank, or trade receivables with a total amount due to the customer. We'll then credit the VAT in the control account. So this is a VAT control account here. And we'll then credit the sales with the net amount, and that's which will be the amount that will ultimately end up with shareholders. Where purchase of input VAT is made, we'll go credit the bank or trade payables with the total amount due. We will then debit the VAT in the control account. So here's the VAT and expenses that company paid, and then we'll debit the purchases with a net amount due, which is the amount that's deducted from the amounts that we'll eventually end up with shareholders. So here's the VAT control account for company C in this table here, where we had it here. They paid over £10 of VAT to company B, paid then onto HMRC, and then they charged £15 worth of output VAT. So that was how their VAT control account would be for those two transactions. And they would pay over a net amount of £5 to HMRC. Lastly, before moving to sales and purchase ledgers, it's useful to gain a strong ability to calculate VAT accurately. VAT is typically 20% of the amount excluding VAT, also known as the net amount, although there may be other rates such as 0 or 5%. 0 can be zero rated when no output VAT is chargeable and input VAT is recoverable, or exempt when no output VAT is chargeable but no VAT is recoverable, and you'll get the VAT rates given to you in an exam. So for any amount of VAT, what you'll typically get in an exam is you'll be given one of the amounts and you'll try and calculate the other two. So in terms of, let's say we were given just the VAT amount and the rate of VAT, well, the VAT amount divided by the rate of VAT will be the net amount. If we were given the net amount and the rate of VAT, well, the net amount times by the rate of VAT would be the VAT amount. The net amount times by the rate of VAT plus 1 is the gross amount. The gross amount divided by the rate of VAT plus 1 is the net amount here, and the VAT amount is the gross amount and the net amount. So you're going to typically be given one of these figures plus the rate of VAT and have to work out the other two. So just do lots of questions and practice it. In an exam situation, it is useful to avoid errors by making sure that you do the following really. So note what the situation is. So is for example, the payment before or after, let's say, the application of a discount? So whatever you've got there, is it excluding VAT? Is it including VAT? Is it just the VAT amount? So note what the situation is there and make sure that you're clear. That's typically the biggest issue where you're going to go wrong in an exam, is you'll just be slightly tricked that let's say you'll calculate the VAT on the amount before discount rather than after discount. Or you'll alternatively be tricked into you should include it that there's a prompt payment discount that you wouldn't include, or something like that. Then you're going to calculate all three of the gross, net, and VAT amounts independently using those above equations. Now, sometimes people use either VAT as a sixth of the gross amount, or a fifth of the net amount, or the net amount is 5/6 of the gross. Just be careful if you're going to use that. That's only applicable for where VAT is 20%. Where you have lists of gross and net and VAT figures, check that the total amount then, once you've created those net, gross and VAT figures yourself independently, then check that they actually add up together so that the net amount plus the VAT is equal to the gross amount. That'll tell you whether you've actually got that right, and that's the term of checking your work. So that's the end of, once you've got a solid understanding of VAT, you're then ready to undertake sales and purchase daybooks and ledgers. So let's go through here a few questions whilst we just got this one. So we got the VAT amount here is £100. The VAT rate is 5%. What are the gross and net values? So in this one here, the VAT is £100, and we got this rate of 5%. So we're going to divide the VAT amount by 5%. Okay, so the gross amount is going to be, well, the net amount is going to be then the VAT amount divided by 5%. That's going to be 2,000. The gross amount then is going to be the net amount plus the VAT, which is 2,100. The gross amount is £240. The VAT rate is 20%. What are the VAT and net amounts? So the net amount is going to be the gross amount divided by 1 plus the VAT rate, so that is going to be £200. And the VAT amount will be the gross amount minus the net amount, so that will be £40. We've got the net amount is £50. The VAT rate is 0%. What is the VAT and gross amounts? So this is just a little trick here in terms of we've got a different rate, VAT rate, but we said it's 0, so it's 0 rated or something like that. Well, the VAT amount is going to be 0 times by £50, which is going to be 0, and the gross amount is going to be the net amount plus VAT, which is going to be £50. That's the end of this chapter.